Tata Chemicals was certainly in focus after their results and their phone call, wherein the street saw their commentary as sounding fairly optimistic about the space and about their performance. Add to that the fact that the earthquakes that happened in Turkey and Syria brought around the chatter around further tightness in soda ash, a pocket where Tata Chemicals is arguably the world leader. So we thought it's best to try and get in Mr. Mukundan to talk about how does he see the overall scenario, not just for the very short term, but for the slightly medium term, and how does he expect to steer Tata Chemicals over the course of the next 2 or 3 years in what I've been now saying is a disjointed world. He's the MD and CEO of the company, joins us right now on the show. Mr. Mukundan, great having you. Thanks so much for taking the time out. Hope all is well.
Thank you, Neeraj. Always a pleasure to be with you. And let me straight away start at the point which you mentioned about the unfortunate incident in Turkey earthquake. Fortunately for this industry, it has not had any dislocation. So the plants are running well. The supply chains are not impacted. There is some issue in the port, especially with respect to relief vessels coming in and some dislocation, but it's not to a major extent the way one would have thought it would be. But I think that's good news. But also, I think we will be monitoring the space because this is underground mine in Turkey, whether there have been any long-term dislocation or medium-term, which we don't know about. But I can only say that as of now, the markets are exactly moving in the same direction as we thought they would. So now putting that aside, I think moving on to the main business itself, I think if you look at the product profiles which we have, the soda ash business, which is distributed around the world, I think we are seeing a very strong market. And we continue to see this even in geographies which we were a little bit unsure about when the Ukraine war started, the unfortunate Ukraine war started, especially in Europe where energy prices spiked up. And in fact, what surprised us has been the strength of the demand and how well it has held, the customer side demand. If you look at one piece of the segment where we do supply our material or our UK into the market is a container glass, Europe has seen the highest shipments of container glass ever in its history during this kind of a high energy period. So that's completely been a big surprise to us. And also a commentary, what our customers have been telling us that they are not seeing any signs, even though we are hearing this R word every time, recession. We also keep debating about it. So rather than worry too much about it, our approach has been that stay focused on the long term and medium term. At the same time, make sure the operating cost levels and operating efficiency are at the highest. I think that's what we can control. We can't control anything beyond that. And we do see this process continuing. Now, as far as the application segments where soda ash goes, I think if you look at the traditional segments of detergents, container glass, flat glass, they continue to grow at about 2 to 3%, a steady rate every year. On a 50 million ton, 55 million ton market, there's about 1.5 million ton additional capacity or supply needed every year. And that's almost like one big plant coming up. And the issue is from the supply side. I'll come to that a bit later. If you leave that broad piece aside, actually the fastest growing segment for us are what today constitutes 10% of that demand, which is about 5-6 million ton, which is around the applications on solar glass, which is driven by the shift to renewable, and also the application of lithium carbonate, where we are seeing a strong demand surge, especially out of South America, which is also driven by the electric energy transition business. So these two are playing into segments of energy transition. Today, they constitute about 10% of the overall demand, but we think in the next 5 years' time, that proportion is going to change to 20% because they're growing almost at twice the rate of the rest of the market. So that's really the one which is sort of shifting dynamics of this business. So really, this product is plugged into the energy transition and is a critical component of the sustainability agenda. Now, if the markets are growing at about overall, leading about 1.5-2 million ton almost every year, leaving, some years could be less, some years could be more, but I'm just putting a linear line there. The supply side, there are opportunities to increase the supply, especially in US, in Inner Mongolia, in China, and also So partly a little bit in Turkey. So if you take Turkey, probably it can move up by 1 million ton or so at best, or maybe 1.5 million ton. I'm not going to hazard a guess. Our views, it's almost peaked. As far as US is concerned, it is the Saudi Arabia of soda ash. So the deposits, they've got a deposit which can run for next 1,000 years. So really, the biggest push there is going to come from the players there, and about 4 to 5 million ton can come on stream. And when it comes to Inner Mongolia, we have been hearing about 4 to 5 million ton coming on stream for a long time. Even if it comes, I think it is going to replace the internal capacities which will be taken off stream in China. So it's going to more or less circulate within China, which is about 50% of the world demand. So and the other element we had also seen last year was this. Even prior to China reopening, China started to import soda ash for the first time from being a net exporter. So that's again a big shift in dynamic. We need to be watchful of this because after that, when they did this, let's say reopening in a very unorganized, slightly disorganized manner, wherein there was a lot of increase in infections and closures and all that. I think it did lead to a period where they again started exporting. But today, China is sitting on one of the lowest inventory levels ever seen. So I think the positioning of this product for next 3 years, at least till 28, 27, 28, I think the dynamic is going to be fairly tight. There could be pockets where there could be a bit of surplus, but I think that they're going to be specific geographies because certain things have happened there. For example, India had a little bit higher inventory going into last quarter, but we think by next quarter that should also even out. So this is a business where I think we have to, as producers, behave responsibly and ensure our customers are serviced. At the same time, I think all of us need to bring additional capacities on stream. Unfortunately for us, most of the capacities would hit the market only by 27, 28. And even when they hit, we think there's going to be a finely balanced business going forward. So that's really the market commentary on this broad business. If you look at the pricing trends, I think all I could say is that the pricing is holding up. There's been a bit of a lot of importance attached to Indian pricing, which went down by 700 or 1,000 tons for rupees per ton for some players. But in reality, I think the international prices have firmed up, and that's reflected in our US subsidiary numbers. And we do expect these prices to hold. In fact, slight expansion of margin in some spaces. So the way I do see the businesses out of our 4 locations, next year we will see expansion of margins, at least in US, maybe holding onto the margin structure in India, and a contraction of margin in Europe and Kenya, which had seen a big expansion this year. If you really look at Europe has had a very, very unprecedented expansion, which I think was mainly because of certain things which came in terms of energy hedging and other benefits which we got. From next year, it's going to normalize. As far as Kenya is concerned, again, it's done very well. They've become a zero debt company. So what we are doing in this period internally is to also, while we add capacities, we are rapidly deleveraging our business. We are committed to the street that we will deleverage our US business at the rate of $100 million a year. We are well on track to do that. In fact, by next year, we'll be accelerating it even more because we see cash flows improve. Kenya has become debt-free already ahead of schedule. We've already hit zero debt position. Europe has deleveraged, I think, to the tune of something like 25 million pound. So their balance sheet also will be lighter. India is already cash positive. So I see all the businesses moving in the same direction. And in terms of capacity addition, we are going to be adding capacity in India, about 300,000 tons, which is already in the works. So we'll go to, from the increase in capacity to 1 million ton, it'll go to 1.3 million ton. US will add about 400,000 ton from its current 2.8, it will go to 3.2. And Kenya would look at expansion in steps of 100,000, but we'll come back with specific numbers once we work our way through the technical clearances, internal technical clearances. As far as UK is concerned, it's fundamentally a business which is pivoting more and more towards cash flows coming from salt business, where I think their investment in pharmaceutical grade salt will finish this year. So from next financial year, which is April 24, They will have additional cash flows coming in from very high-grade pharmaceutical salt. And there we are moving towards what I would call value-added businesses of bicarbonate and salt, and moving up the value chain rather than chasing volume. Volume growth mainly in India and US and partly in Kenya. That's how we see the business in the core. In addition to this, the business which holds a big promise for us is our silica business, which we have built a pilot scale plant in Kadalur in south of India, which is where the tire industry is concentrated. This is a replacement for carbon black. Over a period of time, there are going to be more and more silica added in tire. There, I think our tire line, which was 5,000 ton annual capacity pilot scale, that is fully booked. In fact, it's overbooked today. So we have opportunity to add capacity. The food line is not fully occupied, and I think we do believe that this business has potential to be the next pillar which Tata Chemicals will have. So our first effort there is to increase capacity utilization, also increase the capacities on the ground. And immediately we are looking to taking the tire line capacity from a 5,000 ton to about 13,000 ton. So while our final number is 50,000 ton, and make that business at least EBITDA positive by next year. So we are on a way to sort of build two strong pillars. The third one, the fermentation platform, has taken longer because it feeds into food business, infant food and high standard food, and where customer approvals have taken a bit longer time. But we believe that it's important to persist with that business. It opens up a complete suite of products over a period of time, especially in terms of not just high range food products and prebiotics and probiotics, but also the fermentation technology is a core component of what I would call replacement of plastics with natural plastics. So it does build a capability. I don't know whether we're going to get into that business, but it certainly builds capability. So our effort has been make sure the main engines generate good cash flows, continue to grow on cash flow, seed one or two businesses which are going to be just driving off the what I would call as the sustainability transition, not just energy transition, but sustainability transition the world is going to see, so that it creates pillars and capabilities which we can sort of leverage off over a period of time. The last piece on Rallis, I think we have to sort of admit that we have some work to do there. We have to improve the performance of that unit. So we are engaged internally in terms of seeing what do we need to do to sort of make sure that Rallis regains the pace of performance which it used to exhibit in the past. So some corrective actions have begun, especially with respect to investments on ground in Dahej, where capacity is being built, and also new product portfolio which we're working on. But certainly there, I think we will certainly come with certain additional announcements as we move forward.
Thanks for that lowdown. I'll pick up a few bits and pieces from your opening answer and ask you a few follow-ups. I heard you mention that the global demand supply situation is not going to be very tight. Did I understand that correctly? And therefore, while your capacities are booked out for 2023, which I believe you said in the call, does it mean that pricing too will remain stable? Because as you said, that Turkey situation doesn't really worsen the demand supply math per se.
Yeah. So what I mentioned was that the demand supply situation, even when capacities come on stream, is going to remain balanced or tight. It's going to be. We don't see even after 27 that there's going to be let's say surplus capacities available. It's just going to keep pace with the demand. So really, it's going to be a balanced situation more or less, because I think as a supplier we don't want too much tightness also to persist beyond a point. So we'll be giving it. What I would say, it will be balanced with a strong bias towards slight tightness. That's what we see.
Okay. So how does this work, Mr. Mukundan? I mean, if your capacities are booked out, do you, if the supply and demand situation is tight, is there incremental gains to the operational metrics for you as a company? Just trying to understand how it would work.
Yeah, so I think the dynamic is that we obviously have to keep a very tight control on costs. So, and the big variable there is energy costs. So hopefully the way we see the cost side of the picture is if you look at US, it's the lowest energy producer today of both gas and coal. India is fully on coal, and I think there the coal dynamics are either flat or tending to become slightly softer after a peak which we saw in the middle of last year. As far as the Kenyan operation is concerned, they are fully on HFO, which means they are fully on oil, but they will be transitioning as part of the increased capacity they're going to put in there. They will be going to complete renewable to solar, so that because located in equator, they got very good sunshine, and the renewable seems to be the right direction to go. So we will be working on that piece. As far as UK is concerned, I think they will remain on gas because that's the most sustainable transition fuel across the board, because all our coal boilers are going to switch to gas at some point. And UK already has that 100% gas operation. There, I think we can only move the needle by moving up the value chain to higher value products. So that's really the direction we're taking on the cost side. In terms of the overall patterns of what I would call demand, when the demand is balanced, obviously the pricing power sort of shifts to the manufacturer, and you would see that it'll go to what we call as normal pricing. What had happened in the last few years, this industry suffered a lot because almost 5 million tons of capacity in Turkey came on stream too fast. And that sort of made it an industry which usually used to be balanced into a very unbalanced situation where pricing did collapse. I think we are going back to, I think, a period of normalcy. So, but there will be pockets in markets where there will be expansion of margin. For example, South America has seen a very sharp expansion of margin because the material can most possibly positively move only from US, and there's a premium which is coming there. But overall, I would say that we will be returned back to normalcy in terms of margins, and that will hold. And any further expansion will come through in terms of bottom line, would come through volume addition or traveling up the value chain in higher grades of product.
But just trying to understand for 2023 as a year, if your volumes are anyways booked out, but you're seeing an improvement in margins because of reduction in costs and maybe better pricing as well, it certainly means that your numbers will, because of the base effect as well as booked out volumes and better pricing, 2023 promises to be a good calendar year.
If you say financial year 24 ended, which is going to come, the way we see it is that I think, as I mentioned, the US margins will expand. Certainly, we don't see any issue there because it is a lowest cost producer. It also is enjoying the benefits of the demand situation as we speak, and their costs are going to stay where they are. As far as India is concerned, India volume will slightly increase and margin structure will hold, because unless coal comes down more sharply, but today it is holding its position. It's not increasing anymore. As far as Kenya and US are concerned, the UK are concerned, while the market prices were high, they also had benefits of hedging, which helped them during the current year. So next year, while one would normally expect expansion, they would actually, in a sense, be slightly softer than this year. But if you take an overall picture of the company, it's going to be moving in the positive direction of expansion.
Did I hear you say that your capacities come on stream largely in 27, 28? And therefore, my question would be that how does, therefore, in this business, how does growth come? Do utilizations have room to expand, or would it largely be pricing driven until then?
Yeah, I think if you see the numbers, clearly 27 will be one big shift. But in India, for example, in 24, next year, part of the capacity comes on stream. Year after next, another part of the capacity comes on stream. So some places will come in steps. The big chunk in US will take about 2 years, 24 months at least. So I think each one of them will. So we see every year some additional numbers coming in. But the big jump will be around 26, 27.
Got it. So US earnings definitely inflect this time around, or in a very short term. And maybe as you describe the margin picture, that is great as well. My question is around supply chain issues, the next one. I mean, the chemical industry by and large has suffered from that meaningfully over the last 18 odd months. Are things showing signs of easing out, or is it difficult to predict?
So if you look at Rallis, for example, the supply chain bottlenecks of supplies from, whatever was imported from China, there was an issue. So which has eased as of now. Also, many of us out of India, out of US, where we were exporting, we had port congestion at the beginning of last year. That has also eased. Today, I think the issues we are suffering are fairly local. And let me just say, when I say local, there is certainly some issue with respect to railway freight movement, both in India and US. There are bottlenecks, and that could be seasonal or that may be off seasonal, because when fertilizer movement happens, the rake availability just slows down. And in places where trucking is more important, like in UK, we are seeing truck driver shortage. So even in railways, for example, in the US, it's more driven by the shortage of labor, which is correcting itself. They are doing every effort to sort of recruit more people and bring more people on stream. But it's a tight labor market, which is creating a bit of bottleneck in these places right now.
Okay. The other businesses, Mr. Mukundan, salt, bicarbonate, silica, do they, over a period of the next 2 or 3 years, become large enough relative to soda ash to create a meaningful difference in your overall revenue and earnings trajectory, or will it take some time?
No, in terms of meaningful size, I think we are today amongst the top 5 producers of bicarbonate. We're also, I think, probably amongst the, we don't call it because we are producing only in India and UK. We probably may be the leading producer of salt also in the world. So effectively, I think they are equally meaningful as soda ash in terms of margin and let's say profile. So the one which is being seeded, these are mature business. I would call soda ash, salt, and bicarbonate as fairly mature businesses where we do have pretty strong position, and they will continue to grow. It will go every year at a steady pace because it grows at about 2-3% in terms of volume every year, and we have spare capacity to keep on getting more material in the market. Bicarb, again, we have headroom to sort of grow with the market demand of 6-7-8% every year. That will continue to grow. It is the new business we've seeded in silica and in the fermentation platform where the utilizations are low, which we need to address. At the same time, I think in silica, because there's a very strong customer side demand on the tire line, which is already 100%, it's already hit 100% utilization, we are adding more capacity.
No, I was just trying to understand from relative to the size of soda ash business, how much of a difference, because there it seems to be a steady state business for you. And as you said, it will be cost controls which will drive whatever happens. Otherwise, the capacities are booked. So
let me give a picture, Neeraj. For example, in India, we are increasing the soda ash capacity from 0.8 to about 1 million ton in the next 2 years. But if you look at our salt has gone up from 1.2 to 1.4. I think that will hit 1.5 very shortly. So it's almost gone up 50%. So in fact, our largest volume in India is salt, not soda ash. So but in terms of its presence in UK, for example, it's almost equal. But if you look at the margin structure in a traditional year, I'm not talking about last year was a year where a lot of elements played out. In a normal year, out of 25 million pound EBITDA, which UK used to earn, 15 million used to come from salt and 10 from soda ash. So it is a big earner. In terms of bicarbonate, it's usually 10% of the soda ash size. So if soda ash is in India about 1 million ton, you will get about 120,000 ton as the capacity of bicarbonate. And UK is fully shifting to 120 to 140,000 tons of bicarb over a period of time, because I think the right future for UK is to travel up the value ladder. And these investments have been done already, in the sense that the carbon capture unit in UK was set up just to make bicarbonate, which already is fully operational. The pharmaceutical grade salt is an addition which we are doing to move up the value chain. So they already contribute meaningfully. That's all I wanted to say. And which is why when you ask the question, overall bottom line profile, how is it going to shift? While soda ash shift maybe in small steps, which will happen in the next 2 intervening years, the others will drive the shift.
Okay. Thank you, and thank you for correcting me as well. This really helps. My final question, because we are running out of time now from the time that we've gotten from you, is how do you expect to steer what is arguably, and I ask this to all global CEOs, or how do we expect to steer a fairly complex, diverse, multi-country, multi-product business uh, in a scenario wherein the things are looking fairly choppy, both in terms of availability of capital and the cost attached to capital, as well as the demand, supply, and the access of powers that are getting formed, as I might call them. So, do you expect volatility and uncertainty to be the name of the game, or is business looking a bit more stable after the COVID uncertainty behind?
So I would say we are fully prepared for volatility. I think the only way we think about volatility is we have to do what we have to do, which is run a low cost, highly efficient machine. At the same time, I think bring debt down and focus on free cash flows. I think that's the key message which we have for, and invest whatever is possible which you can afford while you bring down the debt on growth side too, so that you don't lose sight of the growth. So that's what we are focused on. The main way we have navigated during COVID, and again the last year, which was a fairly uncertain year. With it started well, but suddenly you had this Ukraine war and all sorts of uncertainties unfolding. I think the key to managing this is to stay close to customers. I think there's no second guess on that, and keep attracting the best talent. If two things, if they are with us, I think we can continue to navigate not just this level of volatility, the other transition the world is going to see. Energy transition, a big piece. We are working already, as I said, we've committed 30% reduction in carbon. That projects will unfold as we move forward. So every year you will see certain amount of capital being spent on that piece. Similarly, the whole issue related to the digital transformation of the business, every part of the business is investing a lot more on digital transformation. So end of the day, I think these two transition, which is digital AI transition and energy transition and the sustainability transition, I think they're going to be something which will be driving through businesses long-term trend. In between, there could be some bit of fluctuation here or there, but I think we feel very confident because of our close relationship with our customer that we'll be able to navigate this, and that's the only thing which has helped us. I can only say this going forward. That's the only thing which will help us.
We wish you all the best. Thank you so much for sharing such time with us and giving us a lowdown around your performance, and all the best for the quarters ahead, Mr. Mukundan.
Thank you, Neeraj.
The pleasure was ours, viewers. Thanks for tuning in.